Anand Radhakrishnan needs no introduction. I think most of you have met him. Many of you have heard him. Well, he's MD and Chief Investment Officer Equity for Franklin Templeton Asset Management India. In a nutshell, Anand is responsible for overseeing all the local equity funds. And joining him today in conversation is Janakiraman R., Senior Vice President and Portfolio Manager Equities for Franklin Templeton India AMC. Welcome, Anand and Janki. Good lunch? Did you have a good lunch? Light lunch. I had a light lunch.
I had a light one as well.
We've got a busy afternoon ahead of us. And given what happened last night with the US Fed, there are preoccupations literally on every single front. And I know there's a fair bit of curiosity to understand, navigate, deconstruct all of that. So that's what we're going to try and do. But I'm taking a couple of minutes right now to let you all know, in case you didn't, that Anand runs marathons. He loves running marathons. And I'm just curious, did you start doing this because it diffuses work pressures, or have you been a runner since you were a kid?
I've been running since 2010 when I turned 40. Like most of us like to remain fit. So it started like that, shorter distances, 3, 4, 5 kilometers. And then soon it became a bit of an obsession, and slightly more longer distances happened. I would like to recount one interesting incident which I had. I was in 2014, early 2014, I was running in Mumbai a full marathon. That was my first full marathon. So it starts all the way from VT to Bandra.
That's 42 kilometers, folks. 42-kilometer run. Yeah. That's a full marathon.
So it starts all the way from VT, comes to Bandra, and then goes back. While on the way back, I was climbing the Pedder Road flyover, and there is this lady who was standing. Everyone was cheering, and there was a lady who was cheering me, and she handed over me a bar of dairy milk and said, "You can do it. You can do it." I said, "Yes, I can do it. I have trained for it, so I'm going to do it."
Okay. One measure of how addicted you are is how many times a week you train. So, what do you manage to fit in? 3, 4, 5 times a week?
3 times. Now, I earlier used to run more frequently, but now over the years I have moderated. Now I am just running for my own shorter distances, but 3 times a week.
Janki, tell me you're going to start running soon, huh? but hold on. I'm getting to the point here. I will explain why I'm fleshing out this whole business of marathons and running, because I actually think, and I have to admit, I have a husband who's like Anand, a triathlete, a marathon runner. I think there's so many parallels between marathons and equity investing. And take a philosophical view here for a moment. Do you see those parallels?
Oh, definitely. There is a very famous quote I got very hooked onto. In marathon, it says that it's not how fast you run your fastest phase of the marathon. It is how slow you run the slowest one that matters. Which means people generally when they tend to slow down, they slow down a lot, and they kind of hit the wall, they lose the way, and they lose the track of it. I think the slower legs of the marathon is kind of makes it very important. I think in parallel, in markets, we think that how you handle volatile markets, how well you do when things are down, how well you are able to hold on to your grit and determination and your portfolio's quality during extremely volatile, challenging times is what is going to look good through the cycle. I think that's the single biggest, I would say, parallel between marathon running and investing.
I think that's wonderfully articulated. Janki, your interest is in world history and political history. And I tell you, every alternate person, when you ask them about market risks right now, the first word to roll out is geopolitical risk. And I'm saying this is a fabulous time to have a hobby like world politics and history, because it's as connected as it could ever be. Is that the big passion in your life outside of work?
Sorry?
Politics, world history, sort of exploring that space. Is that your big passion outside of work?
It's clearly one of the key passions. I've been quite passionate about history from a young age. I come from a small town which was one of the capitals of the great Chola kingdom. So the interest started there. So then it went into slightly more varied subjects like the Roman Empire, the run-up to the Second World War, things like that. So it's one of the key passions, helps me broaden the thought process. It also has a relevance to investment.
It does. And, the other thing I discovered about Janki is that he's a quizzer. So I'm warning you that there is going to be a tricky quiz question at the end of our conversation. It has nothing to do with the equity markets. Well, it has quite a bit to do with history, quite a bit to do with politics, so please be ready for that. Okay, people are asking. I can see it from their expressions. We have to get down to business, okay? And Anand, I want to talk about the market terrain first. 4 factors. You got inflation, you got interest rates, you got a strong dollar, you got Russia-Ukraine war. I'm picking 4. You can add to that list, but let's start with these 4. I just want to do a sort of quick rapid fire on the global terrain. The US, its management on inflation, is it managing to rein it in? The action that we saw yesterday by the US Federal Reserve, what's it telling you?
So when we talk about US inflation being significantly high versus their own last decadal average inflation, it's like 2% versus 7-8%. So there is a huge dislocation of prices that is happening in not only in US, in many of the other developed markets. But when you kind of juxtapose that to the Indian situation, we think that the domestic inflation of 7% is not a huge dislocation from its decadal inflation of 5%. So in some sense, the inflation that we are seeing in the Western world, where the central bank as well as government stimulated the economy a lot more during COVID, is not the same kind of inflation we are seeing in India or many of the other emerging markets. So I think people tend to equate the policy measures that are happening in US to India and why India is behind the curve. Is it doing enough to cool the economy? I think these are apples and oranges in a strict sense. And I think many of the emerging markets, including India, is in a much, much better position in terms of price stability and fiscal situation, etc.
Okay, I should have clarified at the beginning. I mean, the reason why I'm asking about some of these things is because they may have implications for the Indian outlook or the Indian navigation challenges, not because there's a mirror story playing out here. So, I just wanted to stick with the US picture for a moment and just get a sense from you, Anand, on interest rates going forward, and what did you read even yesterday?
So there is a US interest rate situation where I think it's significantly going to overshoot on the upside because of the policymakers' imperative to cool inflation. And I think there is an Indian interest rate situation where I think we are pretty okay.
Okay.
I think our current interest rates have gone to pre-COVID levels, or slightly even higher than that. And our corporate bond spreads are okay. And generally, the transmission mechanism here is not so debilitating because in US, because the leverage is high, any interest rate move tends to have a positive or a negative influence in a more exaggerated manner. In India, since the leverage, that is debt to GDP, consumer debt to GDP, when all these ratios are much more moderate, I think the sensitivity of the economy to only a single variable of interest rates in India is not that high. And therefore, I think we are, in a good way, we are unpivoted from the global interest rate movement. But I think in the US and the Western world, there will be a bit of an overshoot.
The consequences of war, and those consequences, I think, are still playing out and will take some time still to, absorb fully. Is that a sort of risk factor on your radar as far as global markets are concerned?
So one of the risk factors people talk about is the oil prices. What happens if it stays high for very long, and what is the impact on India? Because we've been running current account deficit, our foreign currency reserves are beginning to come down. Rupee kind of touched a new low today. It breached the 80 level convincingly. So I think there's a lot of nervousness out there. So I think there's one point where I would like to make on that space is that sensitivity, India's current account sensitivity to oil has significantly reduced. In 2012-13, when oil breached 100, our current account deficit shot way above 5%. Today, when oil is kind of hovering around 90, 100, our current account deficit is between 1.5% to 2%. So I think over the years, because of better performance of other export goods, I think our sensitivity to oil has moderated. But having said that, it's a drain. I think it's an automatic tightening of liquidity when you spend more and more dollars on buying same amount of goods.
Yes.
So I think that leads to significant domestic tightening, and that I think is a big risk.
Okay, so distill everything that you've just said in terms of what it means for Indian equities. Stay braced for volatility, but stay invested because India mein hai dam. I mean, I know I'm trying to really pick up words from the theme here, but what's the bottom line?
So bottom line is when the liquidity gets tighter, the valuations will get impacted meaningfully in the shorter term. So I think we are seeing the liquidity kind of gradually getting tightened, but market is blissfully behaving as if it is not a big deal. I think is going to be a bit of a dangerous curve we need to handle.
Okay, talking about valuations, Janki, the valuations are actually on the higher side right now. So they're sort of built up for correction in some sense or the other. Are they closer to long-term averages right now?
It's slightly more than the long-term average.
Okay. So, how are you sort of viewing that? What's your analysis on the fact that Indian market valuations are slightly higher than long-term averages? And you consider Anand's statement saying, look, liquidity is going to be tighter, so there's going to be pressure on valuations. What's your thinking there?
So if you look at the valuation in an isolated manner, then it does appear that it's a bit higher than the long-term average, so it's a bit of a risk. But I think the more dominating factor in this particular assessment is the fact that the next 2 to 3 years, India is likely to see a much better growth rate, the GDP growth rate. Keep in mind that even before COVID, 2018 and 2019 were slowdown years for India, where we saw GDP growth falling from 8 to 4%, and then 2 years of COVID, which means that cyclical recovery is now very much possible. That's one. Second is the fact that real estate cycle and corporate capex cycle, they've started to show signs of revival now. So that is typically the cyclical element which pushes up the GDP growth rate. So in this context, 3 years of strong GDP growth rate, on the back of it, good corporate profit growth, if that is available, maybe it gives me the luxury of overlooking the short-term, let's say, a certain degree of discomfort with valuation. Even if you assume that at the end of the third year, you're going to see some kind of dilution in the valuation, but the 3-year earnings growth will mean that you will end up with a fairly respectable equity returns. So on an isolated basis, is valuation a bit of a risk? Yes. But you combine it with the fact that you are looking at 3 years of reasonably robust growth, then you can take in that risk quite comfortably. That's my view.
You've set me off in so many different directions, but I'm going to have to restrain myself because we have a 16-minute timer out there. And I still have a lot of questions that I want to ask you. But very simply, can you answer this one? You've still got to be braced for volatility in the Indian equity markets, right? There's no denying that. There's no getting around that. Yeah?
There are quite a few near-term factors, like Anand is also mentioning, slowdown in global economy, current account issues. It may impose a degree of volatility in the markets, asset prices. I think that is where our advantage of looking at the long term helps. Now, when I evaluate an idea, I typically have a 3-year time frame. And when you have a 3-year time frame, you will be able to, that should be able to absorb a reasonable degree of short-term volatility. Then you focus on the matters, the factors that really determine, that are really important for those 3-year returns. So it allows you to somehow dampen the short-term volatility.
Okay, fair point. What's your view, Janki, on the mid and small cap segment of the market? I could go through my outsiders list of GST, demonetization, IL&FS effect, COVID, and I could say, and I'm no expert, so I'm not pretending to be, but I can say, I mean, these were bruising chapters, right, for mid caps, for small caps. They borne the brunt. But have the concerns receded?
The way you pose the question, it is like mid and small caps have just now completed an Ironman challenge.
I feel like they have. I feel like they have.
So, quite a lot of challenges have already passed us, that's one. Second is, a lot of progressive legislations that the government did over the last 3-4 years are now beginning to come to fruition. Charlie Munger, one of the founders of Berkshire, most of the people in this auditorium will know, he used to talk about a thing called the Lollapalooza effect. You have quite a few factors, and when many of them come to fruition at the same time, then the outcome can be quite reasonably powerful. I foresee that kind of a phase for the next 3 years, with all this the progressive reform measures that the government has taken in the last 3 years, that will come to fruition. And the fact that cyclically the economy is due for an uptick, capex cycle is again showing signs of revival. You combine these three, which means that you're going to see an accelerating GDP growth rate. That kind of an environment, mid and small caps will do well, despite the fact that the last 3 years they've done much better than the large caps, they'll still continue to do well. I mean, in line with the theme of this event, I would say that mid and small cap mein hai dum.
Janki, you like private sector banks in particular, the banking sector in general. It would be great to revisit your hypothesis on that right now.
See, this sector has not done well for the last 5 years. It went through a lot of challenges. But at this juncture, if you look at it, the customers, the clients, their balance sheet is strong. They are prepared to now reinvest in capex. Private sector, households, leverage continues to be low. So which means that the retail demand for credit will continue to grow. Most importantly, the balance sheet of banks has been thoroughly cleansed in the last 3-4 years. So the profitability which was suppressed due to the credit cost, you're going to see a revival in that. Combine all these three factors with the fact that last 5 years the returns have been quite weak from that sector. I think one should be very disappointed if the next 3-year returns turns out to be anything less than satisfactory.
Very interesting choice of words. If the returns are anything less than satisfying, define satisfying, but I'm not going to put you on the spot right now. Fintech, food tech, again, Janki, these are spaces that you like. What is the profile that companies? What is the USP or the defining characteristics that in particular you like?
See, in these areas, these are businesses which are quite nascent. So it's a bit difficult to evaluate them from the framework of a traditional mature company. What we look for is a business model which has strong unit cost advantage, large addressable market, and viability in the business. That is more important. This is a very, very challenging trifecta to achieve. If a business model has all these three components, I think then it gives you ample ammunition to be more bolder in terms of investing in these models, which is the approach we have taken with the sectors that you mentioned, either food tech or in fintech. And I think the opportunity is fantastic for the next 10 years. And if the model shows signs that it passes muster on all these three factors, I think then you have a good investment in your hands.
Well, right now I've been approaching everything through the positive lens, but if you had to trim positions right now, where would you trim?
Businesses which have a very high global exposure. I think developed market, the growth is going to be a bit muted, probably decline for the next year or so. So that's an area where one has to be a bit careful. Second, last 2 years during COVID time, a lot of businesses saw dramatic expansion in margins for a variety of factors. These are all not sustainable margins, but Street in its own wisdom tends to extrapolate such margins. So those are the areas where I'm a bit cautious. Conversely, some sectors went through some compression of margins. People who use energy, people who use industrial raw materials, all these companies saw a reduction in margins. Now that these prices are normalizing, you will see a reversal in those cases, and those are the areas where I'm willing to be a bit more bolder.
Okay, interesting. Talking about the domestic story, yeah, I have to say I like tag phrases, but I like to break them down and ask what they really mean. So Anand, I'm putting this one to you. Atmanirbhar Bharat.
Yeah.
Well and good, but what specific opportunities is it throwing up that you can map, that you can see?
So if you look at this opportunity for indigenization, there are clearly the areas which are prone to indigenization is where we are not present currently, and we are predominantly dependent on imports. I think electronics is the one thing. I think day before yesterday I saw Apple making an announcement that they are shifting away from China, certain 20% of their iPhone 14 production immediately, that is instantaneously. And this China plus one strategy is real. I think there is a lot of doubt in the minds of the investors, market participants, that is it an India-created imagination or it is actually really there. I think this China plus one strategy is for real. Whether we like it or not, companies are diversifying beyond China, and therefore that will give a lot of opportunities, whether it is in the electronics manufacturing space, specialty chemicals, pharmaceuticals, light engineering goods, automobiles, components, and more importantly, the new energy sector, where India is totally absent. We are consumers of those equipments, those panels, etc., but we are not big manufacturers of that. I think over the next 3-5 years, we will see Indian corporates willing to invest reasonably large amount of money on the new energy, be it solar or hydrogen or battery technology, etc. But that is new, but there's also a lot of old, which we have to indigenize. Classic case is defense equipment, which people keep talking about. India spends billions of dollars annually importing basic things, not very high-tech defense goods. I think we will see opportunities in that space as well.
But that goal has been articulated a while ago of indigenization and defense. The enabling infrastructure theoretically is in place. I mean, do you see that really gaining enough traction for that idea to play out?
In India, infrastructure will be a lagging indicator. I think demand will be the demand or the effort will be the leading indicator. India will always, because capital is starved, you can't imagine that we will create infrastructure first, like big ports, special economic zones, free trade zones, and then ask people to kind of set up manufacturing facilities. I think it will be the other way. People will set up manufacturing.
It's always been that way in the Indian context.
So I don't think that situation is going to change in the shorter term. But what are the more enabling factors? The willingness of corporates to invest. Corporates became very capex shy over the last decade because they got stung by the post-GFC mall investments that happened in India, power sector, infrastructure sector, so many sectors. I think most of the corporates are very shy to invest behind big projects. I think that will come back. I think that willingness to now stake big amounts of capital, whether it is Tatas, the Birlas, the Ambanis, and others, I think that is going to be a big change versus last decade. That willingness will be the driving factor behind the CapEx cycle.
Okay. Congratulations on the Balanced Advantage Fund. I want to just, talk about that in a little more detail. What's the investment approach with it?
So there are multiple levels we hope to add value in that fund. It's a very important fund for us because we have launched a new fund after a long while. But it's also a very beautiful entry-level product for many investors for the sheer fact that it does the asset allocation. So I think the asset allocation is going to be a very, very crucial and determinant factor in FT Balanced Advantage Fund standing out away from the peers. I think that is first level. Second is within the sleeves, equity, fixed income. We would like to be the active portfolio on the equity side is going to be adding value. It's true for others as well, but I think we have a small edge in terms of our research, our approach to valuing companies, our approach to picking stocks, etc. So there is this equity level alpha, there is an asset allocation level alpha, and hopefully there is also a rebalancing level alpha. That is, rebalancing the portfolio at opportune moments and in the right manner is going to add alpha. So it is not only a simple asset allocation product, it has alpha or ability to add value embedded at multiple levels. And that's why I would say that it's a very good product. So we remain very confident of running this strategy well.
I want to sort of go behind the scenes for a moment with you, Anand, on this one, because I want to try and understand what are the tools at your disposal in your armory to really have optimal fund management, like in the case of Balanced Advantage Fund. I hear from the Franklin Templeton leadership about proprietary tools,
Yes.
Proprietary insights that set you up for more optimal management. Can you take us behind the scenes, just walk us through it?
So more than the magic wand or the sandbox toolkit kind of a thing, which is what we have, I would say being part of an emerging market group.
Yes.
We collaborate a lot. Our research team, our portfolio managers, when they take a view, they know what's happening in other parts of the world. Similar companies, how they are doing. We participate in daily calls, weekly calls with our emerging market team, and our emerging market CIO is here. You will hear from him soon. I think that's the single biggest strength that we have, which our peers don't have. I think their ability to gain from their perspectives and incorporate that in our thinking is a qualitative thing, but it adds value over a period of time. It enhances our understanding on multiple sectors. For example, if you want to understand about solar cell, EV technology or a battery cell technology, then I have to go internally. There is an expert internally, and he covers stocks in China. And you can collaborate, understand, and get some knowledge transfer from that very easily. I think that is the single biggest advantage we have.
Well put and revealing. Final thoughts, Anand, that you wanted to share with the distribution fraternity, with the partners that are present here today.
So, big message I want to leave with the partners here is many of our funds went through performance challenges in 18, 19, and many of them are beginning to deliver good performance over 1 year, 3 year, and some of them are now catching up significantly on a 5-year basis. We still are working on improving our performance on some of the mid and small cap, which we are confident of achieving that. Much like the way we turned around the other bigger strategies, we are very confident that our mid and small cap strategies too, and we remain totally committed to delivering value to our investors. And I once again we thanked you. I once again thank all of them for standing with us during tough times and also helping us and making our NFO decent, good success. And I'm very thankful to them on that.
Anand, Janki, thank you very much for talking to me today. Great talking to you. Thank you. I think they'd like to.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.